Welcome to Money Hangout once again. Every week we talk about something which is important, useful from your financial standpoint, and try and answer as many of your mutual fund questions and help you understand mutual funds in the process. This is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about investing for your family. It's not exactly investing for your family, but the fact that you are part of this hangout, you are financially inclined, you are interested, and you are knowledgeable. So you are effectively the opinion leader in your community, in your family, and so there is a greater responsibility on you. You can share the knowledge with people in your family. There are certain things which is very hard to it can actually get communicated more effectively by somebody who is accessible, who is part of the family, so there is absolutely no distrust. And the fact that you are part of this hangout and you have been looking at or you have been reading value research online, you have been curious about financial issues, so you can play a very effective role. There are 2-3 aspects of it. One is the very basic aspect, that how to communicate basic financial stuff in your family and how to organize yourself. One is that we have all our investments, savings, and money lying in our bank. So communicating openly with your family about these issues, how they are kept, and how they can be realized, what is the utility, what is the plan, why they are invested the way they are. Keeping an open communication, it helps people comprehend things better, and the money will be put to good use just in case you are not around. So in that sense, spreading the knowledge, the basic knowledge, is useful. But that apart, I think there is a far greater, effectively you are the opinion leader, you are the repository of knowledge. You can play a very effective role because people trust you. You have absolutely no vested interest. You will always be saying things or suggesting things which will be in the best of their interest. You will have absolutely no bias there. And the very fact that there are such financial myths which prevail for a variety of reasons, and there are such behaviors which is entirely driven by the environment. For example, the youngsters in the family, they need to be communicated that even something basic, that the magic of compounding, how deferring a spending for a while can actually translate into something so meaningful, and a habit which can come in, which can lead to general happiness over time. Likewise, for the older people in the older generation, they need to be told in terms of how to manage their finances in a manner that they don't run the risk of outliving their savings. Many a times, and the way things have worked in the past, why they will not work the way in the future, and that particular risk, and that could be quite alarming for some, and it may not be alarming for some. There may never be an urgency, because the opportunity losses, which you can just be conducting your financial affairs in a manner that you will miss a lot of opportunity. You will miss a lot of opportunity because historically you have conducted your investments or financial affairs in a certain way, and that is going to be counterproductive. That might be injurious to you, and that is not going to disrupt your financial your financial needs. So in that case, even the opportunity loss will not get registered in your mind, but it could be a very meaningful opportunity loss. For some others who are on the margins, if you are going to depend on your investments for income, and if there is a possibility that the future income from your investments will not be enough and you will run short of it in your lifetime, that is going to be a distress that will cause serious distress, and one needs to prepare for it in a very methodical way with a fairly great deal of understanding. This requires education. So I think so there are 3 things which all of us can play a role. I try to do it in a limited way in my own surrounding, but I find that there's great reluctance. It is a very hard thing to do. Somebody who has conducted his financial affairs in a certain way for 30-40 years, persuading him gradually, you should set a target for yourself. Somebody who can face a distress, I think you should have a 1 to 3 years time frame whereby you will gradually hammer this idea in their mind. Somebody for whom it is not a distress, it will not cause a distress, have a longer time frame. For the youngsters, there should be 3, 4, 5 essential things which they must understand. How to park their surplus cash, why surplus cash should always be deployed, how to make sure that you are availing the tax benefit, tax saving, tax saving on account of tax saving investment which you can do, because the formative years are just as crucial. And communicating your financial affairs, how to keep the records, how to communicate, telling your spouse about the various objectives for which various investments are being made, the liquidity and the tax treatment of that, because these are very basic things. I am quite surprised that very educated, learned people, when they are being told those 4 or 5 things to be done and why it is to be done like that, I find that they are quite awed by the simplicity of it. It is not a very hard thing to understand, and spreading the message, spreading the knowledge, you will actually play a very important role in their lives, and it will have a very lasting relevance. So thank you very much. Spread the good word.
Thank you, Dhiren. In our first question, Amir asks, how is it that you're so sure that the coming 10 years will be golden years for the equity market?
I'm not very sure, but I'm reasonably confident that, because the structural things which are changing in India, 3 things which comes to my mind which make me very confident, and I may be wrong, and that will be proven only after 10 years. But 3 reasons why I feel very confident. One is the structural changes in the business. The current problem that we are going through is the GST migration. I think this is going to really turn things in a very unusual way for the businesses. Everything gets accounted for, and we are moving a step ahead in terms of being a developed economy as far as accounting for our economy is concerned. That's one. The other is that, India is an island of growth given the demographics, and that is actually visible. All other economies globally. So we see those flows coming to India. So first point, that will unleash a lot of entrepreneurship, a lot of businesses being, sprung into much larger organized businesses, and that will create a great opportunity in the stock market. Second is, India is an island of growth in an otherwise bleak outlook for the global economy and all other parts of the geography. So that is another thing. Third is the interest rates and inflation being dealt with in our economy in India in a very unusual way and very intensely. That is driving down the interest rate, and that might turn out to be, of course, the interest rates are cyclical. It may not remain very low for a long period of time. But I still feel that going by the structural changes in our economy, they will come down, and the level itself, the baseline itself will change and go down lower. That will cause interest rates to go down, and that the initial thing we are witnessing right now, the domestic flows are likely to continue, and the kind of momentum that has been built. Given all this, plus all this, there are many things, the structural change which I was referring to, when you look at the digitization, the way people can invest, the way people can actually access the market, the way they can participate, the transparency of it, the investment options available to investors in the country. So these 3 things makes me think that, and it has not been possible in the last 30-40 years. Of course, we have been reforming, but I think reforms in our country, in India, has come to a point where it is happening in a sustained, routinized manner, and businesses are getting respect. Good businesses will actually gain valuation and respect. They will actually be rewarding. This, I think, is a very fundamental change in our economy in the current regime. So that is why I am very hopeful. Only 10 years from now we can say that was it meaningful, was it true?
Indeed, Dhiren. Next up, Mr. Desai asks whether mutual fund folios should be in joint names. If so, what are the tax implications?
Ideally, mutual funds, if you think that it should be held jointly, It should be held with your spouse. So, it eliminates the need to actually have the will plus a nominee whom you would like these assets to progress to, or being succeeded to. But the tax implications are fairly straightforward. The first holder of the investment gets all the tax break, and that is only in case of the tax saving fund. All other investments, it will be shown for the first holder only, the long term capital gains or the short term capital liability, capital gains liability, if any. Only the first holder will be liable for that.
In our next question, Kunal says that he inherited a portfolio of stocks from his parents, but he doesn't understand stocks. He asks if he should just let them be or give them to a portfolio management company to manage.
Depends. If he is inclined to understand further, then he should really do a review of that. It will be interesting. It is an intellectual pursuit, and he will also learn in the process. And he has inherited it, but that doesn't mean that it is his investment now. So he should work towards understanding it, maybe supplementing with his own investments in that portfolio. And if he is not inclined, then there are two options. One is that he can entrust that money to a portfolio management company, but there are portfolio management and mutual funds, there are various aspects which are different. One is portfolio management is lightly regulated, mutual fund is very intensely regulated. Mutual fund, they come up with a valuation every day. You see the NAV, you see the portfolio disclosure, you see the performance track record. PMS are not, PMS you don't know which one to choose. How will it conduct? Portfolio management services giving a power of attorney to somebody to manage your investments. There is one significant tax difference when you invest in a mutual fund, or when you run a stock portfolio. All short-term investments, you give your, say, you put 5 lakh rupees in or 25 lakh rupees in a PMS. The portfolio manager of that PMS service will buy and sell, and any short-term gain accruing to in that portfolio, you will be liable for that. When you invest your money in a mutual fund, if you invest 25 lakh rupee and the portfolio manager of a mutual fund buys and sells something, he will not be you are not liable for the short-term capital gains tax, nor is the portfolio, nor is your mutual fund, till you hold your mutual fund for 1 year and more. Because holding equity portfolio or a equity mutual fund for 1 year and more qualifies as a long-term capital, eligible for a long-term capital gains. Whereas PMS, each and every transaction will be subject to taxation depending on the time held. So you have to really get choosy, and the information available on mutual fund is in the public domain, because that is what the regulators want them to do. You get the portfolio every month, every day, portfolio every month, NAV every day. Any changes, it has to be published, and you are in the know. You get your account statement. And PMS, it is your arrangement with the portfolio service provider. The minimum investment needed for a PMS is 25 lakh rupee, mandated by the law. You can make, you can have a mutual fund and then contribute small monies as well in that portfolio to continue building it, because one, that you have inherited a portfolio. The other is that you can also contribute and build it further with your own savings. So net, I think, for if you want to keep it simple, first and foremost, try and manage it. If you are able to develop that understanding, it will be useful. It will be interesting. Else, go for a mutual fund.
In our next question, Neeraj asks quite simply, if now is the right time to start an SIP.
It is always a good time to start your SIP. You need two things. You need to keep two things in mind. One is that you are investing the small money, or you're investing the money which you are unlikely to need for a couple of years. And the other is that you will stick to this plan. If you do this for 2-3 years, I don't think you need to really wonder about it. If you keep waiting, if you think that the market is at a high and you are reluctant to get started, you have missed it. We have waited for this market to correct for 3 years. Many investors are still waiting. There is a possibility that correction might happen. Doesn't matter. If correction will happen, you will continue to do your SIP, and those SIP investments, installments will actually get invested at lower price. But if you keep waiting, I think the price of the opportunity loss of not getting started is too steep. Get started now.
Next up, Milind asks how he can invest in the wine index.
Consider wine is for a purpose, enjoy it. Don't think of it, it's an exotic investment, it's an alternative, it is, I don't know how it works, and you should not really work towards understanding that. Ignore any such investment, any such exotic investment which is hard to understand.
Next up, Mr. Agarwal asks how he can keep a regular track of his funds on a daily basis with all his information in a single place.
Ideally, you should not look at your investment values every day, but if you're just curious, or once in a while you're watching TV and you see that the market has gone up by 100 points, or the market has fallen by 300 points, if you want to set up your portfolio at Value Research Online, this is a place where you can monitor and get a daily valuation in a fairly timely way with analysis every day. The market closes, of course, during the day. Your stock values are updated on a live basis with a 10-minute lag. And the mutual fund portfolios, I think we update the portfolios very efficiently every evening at 9:30 or so, as and when we get the NAVs. So you can track all your stocks and mutual funds and other investments too, including even NPS at the portfolio manager at Value Research Online. But generally speaking, don't be curious to look at the portfolio values every day. It causes anxiety, and that is avoidable. Of course, you should keep track of investments, so set up your portfolio. We also have an outstanding feature which makes tracking of your investments very efficient. CAMS and Carvey, the two registrar company, provide you a consolidated account statement of transactions. You can go to these websites, put your email ID for which you have used for making those investments, which you have provided in making those, while making your mutual fund investments, and you get a consolidated transaction history. You can also specify the date from which to which you need. So ever since you started your mutual fund investments across any fund company, you will get a consolidated statement. You can upload that investment at Value Research Online in the portfolio manager. There is a simple tab. You do it exactly like the way you attach a file while sending a mail. It is like a file attachment in an email. You do that. While you are getting this portfolio statement from Carvey or CAMS, you have to specify a password. So that system asks for that password to read your file. And you don't have to input. You don't have to type each and every transaction in your statement. All those transactions get assimilated. They are automatically put in the portfolio, and then your tracking starts. It is accurate, and periodically you can fetch that statement again and upload it, and all the additional transaction made after your first upload will also incrementally get appended there. So this is a very efficient way of tracking at Value Research Online, and we are adding some very advanced features in future. So this will be to my mind, of course, it sounds little boastful of talking about my own service, but I think this is the finest way of tracking your investments for free.
Next up, Farooq asks if it is better to do an STP from a short-term debt fund rather than a liquid fund, since the former offers higher returns.
Yes, it really won't make great difference. But yes, sure, if you are actually putting a large amount in to be transferred over a long period of time, maybe 2-3 years, a significant amount of money, the difference could be meaningful. Yes, it will produce little more return.
Mr. Gopalakrishnan says that his daughter saves about 1.5 lakhs per month. What would you recommend for her as an investment strategy? She currently has a 50-50 debt equity mix.
Depends when the money is needed. I think if one has worked through a plan, that the likelihood of emergency money which you can access anytime, put that money in a short-term debt fund or a liquid fund, or a combination of bank savings account which is accessible, something like that. And beyond that money, I think 50-50 is a very conservative way. I think in a growing economy, the kind of optimism which prevails, and more so, if this money is for many, many years, the initial years, the money invested in equity will produce much larger return. And if you have all that time, maybe move to 70-30 kind of allocation. And if you do it with simplicity of a balanced fund, that will be a good way to start. And then over a period, maybe 3 years from now, once you have experienced the ups and downs of the market and the relative stability of the balanced fund, frankly speaking, I would say that it entirely depends on the likelihood of she requiring the money, the time period for that, and a plan should be guided by that.
Next up, Mr. Durukar says that he is confused between equity, balanced and debt funds. He asks if he could explain the difference between them and tell him which ones are best suited for him.
Equity, balanced and debt funds are, the name itself is quite self-explanatory. Equity funds invest in shares. Debt funds invest in bonds and, variety of bonds. Equity funds invest in a variety of shares. And balanced funds invest in a variety of bonds as well as shares. But the balanced fund, the popularly referred balanced fund, they have a 70% allocation to equity, 30% allocation to fixed income, generally speaking. And that is why the tax treatment, the returns or the gains from balanced fund is treated as equity, because that is what our tax laws stipulate. For investment to be treated as equity in a mutual fund, it must have an allocation of 65% and more in equity at all times. That is what these balanced funds do. So balanced fund is a great way to have an equity heavy portfolio with reasonable stability and the tax treatment of equity and all equity investment. Equity is a diversified portfolio of shares, and and fixed income funds, as you understand. And then there are variety of equity fund, variety of balanced fund, and variety of debt funds. Debt funds are primarily, the variety of debt funds you should choose depends entirely on your investment time frame. Money for few days, consider a liquid fund. Money for few weeks, consider a ultra short term bond fund, so on and so forth. So you have the short term debt fund or the income fund or the dynamic income fund. They are the variants of that. So longer the time frame, or if you are looking for a defined time frame, consider a fixed maturity plan, that they give you a reasonably predictable return for a defined time period, for a fixed time horizon. They are equivalent of a fixed deposit in the shape of a mutual fund. So sometimes they can be more tax efficient. I think tax efficiency of a long term bond hold fixed income fund is very interesting if you are a very conservative investor. Balanced fund is a good vehicle for long term equity oriented investment. If you are a scared, if you are a conservative investor, if you have never invested in the past in any market linked investment, so it's a good way to start, because they are not as volatile as an all equity fund. And then there are different kind of equity fund. The large cap funds invest in larger companies, big companies. Mid cap funds actually invest in mid-sized companies, and smaller companies funds invest in small cap funds invest in small companies. And their characteristic changes because the small companies fund are very volatile. Mid-sized companies can also be volatile, but far less than a small cap fund. Or large cap funds tend to be relatively more stable, predictable, and balanced fund, as I explained you. But it's hard to suggest any fund, because these are the variety of funds. But basic thumb rule to follow is that money which you need in a predictable time frame, in 3-4 years time frame, and that money should be invested in fixed income fund. Money which you are unlikely to need in foreseeable future, 5 years and more, you should consider some equity oriented investment, because they tend to optimize your return. You should never consider investing your short term money into equity, because it can actually it can give negative surprises. Equities, shares, investing in an equity fund could be very risky if you are investing for the short term, because equities do very well over a long period of time, but short period of time they could be extremely disappointing, and markets correct, it could be very turbulent. So these are basic rules to follow, and keep listening to these hangout sessions. Hang out with us, and you'll learn more and have the confidence to get started more confidently.
In our next question, Guru asks if he should directly invest in the stocks held by top performing funds in the same proportion rather than investing in the funds themselves. He says that a 200 rupee demat fee is much lower than the mutual fund expense of 2%.
Yes, that fee is definitely lower than that, and if you can do that, but I think the portfolio that you will get from a mutual fund company uh, will be on a monthly basis. You will have to do all the calculation, what has been sold, what has been bought. I think you get little greater convenience, but it is a tactic which can't be ruled out. And uh, but the convenience of getting, if you are doing your trades yourself, keeping track of it, doing the filing, generating short-term gains from your portfolio if it is an active portfolio, because every month you will have to buy some, sell some, based on, if you compare your portfolio with the mutual fund. Mutual fund managers will also be doing something in the interim during the month which you will not have access to. So besides this, if you want to have a quasi replication of that portfolio yourself, it is possible, but it will come with some work for you.
Next up, Makrand asks if a real estate investment trust will give better returns than investing in physical real estate.
They have yet to really become mainstream. We have just had a small start. First, the regulatory framework has been prepared for them to start. I don't know. The framework of the real estate investment trust is very different. It is going to be a combination of commercial real estate dominantly, and which is good to, ready to use, which will produce some income. And over a period of time, it is expected that the listed real estate investment trust will appreciate depending on the investment value of the underlying assets. That apart, real estate investment trust, the rental income from those assets, primarily invested in commercial real estate, normally they have a escalation clause, or the rent revision clause, which generally ranges between 10 to 20% every 3 years. So if you are looking at rising income, as compared to that, when you buy real estate yourself, you are assuming all the risk without the diversification. If you are actually buying something which is which is under implementation, you are also taking a risk on the developer, his ability to deliver your asset on time. And then it is all equity, it is not an income producing thing, and lack of liquidity. So I don't know, it still has to evolve. I think the way real estate investment trust has been conceived and the way it works elsewhere in the world, it is likely to be slightly higher reward, a little more rewarding than fixed income, with some gain potential, with marginally higher gain potential. That's about it, as compared to you personally holding real estate, where you assume all the risk and possible returns, and great risk of losing a part of your capital or sitting on, and it requires a lot of attention. Whereas real estate investment trust will be a mere financial investment. There you will have to worry about the upkeep, looking for a tenant if it is to be rented, and looking for a buyer when you want to sell it.
Next up, Samir says that he's been investing in mutual funds, PPF, gold ETFs, NPS, and some ULIPs. However, he is leaving India for work for a long period of time. He asks if he can continue investing in these products, and if so, how?
Yes, he can well continue investing in all these products except for PPF. In PPF, your investments can carry on. Whatever you have made, whatever you have deposited in your PPF account is fine. Subsequent investment will not be possible. Except for that, all other investments you can carry on.
We now move to our final question. Anil asks, very simply, how he can get a 12% return in mutual funds.
Lot of investments today, if you look at 5-year, 10-year, 3-year return, you will find that 12%. Many investments have delivered. Even a conservative MIP or a debt-oriented hybrid fund would have generated that kind of return. Most equity funds would have given more than that, but it's not a bankable one. It depends. If you are looking at 5 years from now, I'm hopeful that even a hybrid-oriented, debt-oriented hybrid fund will also produce that, likely to produce that kind of return or close to that. If you want 12% annual return on a continuous basis, there is no such fund. There is a possibility, because all these returns, they come in, sometime they come, sometime you get lower return. Because if you look at equity return, they come in a fairly unusual way. When you are looking at 10-year return of 20%, in couple of years funds would have given you a return of 30%, 35%, and in some years it would have been negative or single digit return. And on an average, it translates into a 20% return or 18% return or 15% return. So it will come in a fairly inconsistent manner. Looking for a 12% yielding mutual fund, there is none.
Thanks, Dhiren. Any final comments?
Yes, you are privileged to hang out with us, and we are privileged to be with you. Spread this word, and I think that will translate into far greater impact on your family's well-being, and sharing the understanding with the youngsters, and persuading your older generation to think logically about investments, because things have changed dramatically. This can translate into something very tangible for your family.
Thank you all for joining us.
Thank you.
Join us next week on a special hangout session where we will be joined by one of the key figures in the mutual fund industry, A. Balasubramaniam, CEO of Birla Sun Life Mutual Fund.